IVM.
BQ Big Decisions, the Bloomberg Quint podcast that helps you make the right financial choices. What's the first thing that comes to mind when I say mutual fund investments? No, I mean, apart from the familiar disclosure that you've heard so often, you know the one, mutual fund investments are subject to market risk. Chances are that you thought of something to do with investments into equity. And you aren't alone. Most people are either unaware of debt mutual fund schemes or pay very little attention to them. Thanks for tuning in. This is BQ Big Decisions and I'm Alex Matthew. On today's conversation, I'd like to talk about debt mutual funds, their types, uses, and why you should definitely consider including them in your portfolio. Joining me this weekend is Amol Joshi, the founder of PlanRupee Investments. Thanks so much for joining me, Amol.
Pleasure to be here, Alex, on this show.
First off, am I right in assuming that a lot of retail investors aren't really as familiar with debt mutual funds as they are with equity mutual funds? And why do you think that is so?
Well, you are absolutely spot on, Alex, over here. Most of the times when a lay investor thinks about or talks about mutual fund, equity mutual fund is what is in his mind. Number one. Number two, why is it so? I would say that the reason why most of the times people think we should go to mutual funds is to earn better or higher returns than traditional fixed income investments can generate. And that potential largely rests with equity mutual funds. And that's the reason why most of the times mutual funds are broadly equated as equity mutual funds.
Okay, so that's fair. The return is what causes people to classify or think of
Top
equity.
of the mind recall is due to the higher return potential.
But that's not necessarily the case. At least over the last couple of years, we've actually seen something completely different. You've seen several debt mutual funds that have done better than equity, their equity equivalents.
Correct. That's correct. The simplest reason, and we should not go into the details beyond the scope of this talk, but the simplest reason is equity has not been doing well.
Exactly.
Equity, as we know, has its own ups and downs. And since currently we are in a down market sort of a phase in equity, that's the reason why you see debt doing better than equity.
But right off the bat, let's talk about this. There are several advantages to having debt funds. Let's quickly talk about those advantages. And here we're primarily comparing them with the most popular fixed income instrument, which is fixed deposits. So we're talking about this as an alternative. What are the advantages to having a debt mutual fund as part of your investment portfolio?
See, 2-3 quick advantages that come to my mind, and very important advantages at that. First and foremost is liquidity. So you have certain category of funds like liquid funds, savings funds, ultra short-term funds, etc., etc. These funds do not have any exit load. So even if you decide to invest for, let's say, a 6-month period in a liquid fund, and you end up redeeming this amount in 3 months, which is less than what you originally intended, still there will not be any exit load. So
which is basically, just for people who are not familiar, the amount of money that, or what money the mutual fund charges you when you redeem your investments in a mutual fund, basically.
That is correct. But exit load, as I mentioned, some of the schemes do have exit load. If we typically take an example of equity fund, most of the equity funds have an exit load of 1% if you redeem in less than 1 year period.
Fair enough.
So a fund like liquid fund or an ultra short term fund do not have an exit load, and that's first advantage that I spoke of. That advantage is liquidity.
Sure.
Number one. Number two, very important advantage is a tax related advantage. So since we are comparing here with traditional fixed income instrument, that is fixed deposits, no matter how long you hold onto a fixed deposit, the interest will always be added to your income and it will get taxed at the rate of your own nominal tax slab.
Now, I just very quickly want to go into this a little bit, and we talk a lot about tax, Amol, but a lot of people don't pay attention to fixed deposits when they're calculating their tax. So the interest that they earn for the full year basically goes and sits on top of their net taxable income.
That is absolutely correct.
Right?
Yes.
So assuming that their net taxable income comes to about 10 lakh rupees,
right,
and they've earned interest on fixed deposits to the extent of 1 lakh rupees,
right,
that means they're being charged at 30% of 1 lakh, which is their tax of 30,000 rupees over and above the tax that they're paying on their salary.
That's absolutely correct, Alex. Absolutely.
All right. So what happens with regards
So
to...
if you invest into a debt mutual fund and if you stay invested for 3 years or more, once you redeem, you qualify or you get you get a tax advantage called as indexation.
Okay.
Indexation simply means that during this period of 3 years, let's say the inflation, which is nothing but erosion in purchasing power of your money,
or the increase in the prices of
increase in prices of goods and services. If the inflation is 5% and let's say your debt fund has earned you 7%, just for an example, so instead of tax being charged on the entire 7%, as you explained in the case of fixed deposits, the tax will be charged only on the higher than inflation component. So let's go over the numbers again. Debt fund generates 7% return. Let's say 5% is inflation, so tax will be charged only on the 2%.
Okay.
We understand that obviously it will be lesser amount. Plus another advantage is, even if your tax bracket is 30%, instead of 30, you will be charged flat 20% tax.
And
so tax is lesser percentage, as well as tax is applicable on lesser amount as well.
So it goes without saying, Amol, that the larger the amounts, the more advantageous it is.
Absolutely.
Because a tax would significantly eat into your returns.
Correct.
There are more advantages?
Yes, there are more advantages. One of the other important advantages is from liquid or from ultra short mutual funds, you can switch into equity funds whenever you want. So that can be utilized, something called as SIP we all are very familiar about, but there is something called as STP, which stands for Systematic Transfer Plan. Via STP, you can invest lump sum into debt fund, where you are likely to generate higher than saving account return. And Alex, I'm sure you have kept yourself updated. A couple of days back, the saving account rates have been reduced by the largest bank in India. So you are likely to earn better than saving account returns, and then you can systematically switch your corpus from debt fund, that is liquid fund, towards equity. So you can set up a STP is also one of the advantages.
And the high degree of liquidity in these funds also allows you to keep a contingency fund in a liquid debt fund, right?
Absolutely, yes.
Okay, now to understand debt funds, we've gone through the advantages, but
right.
I feel to understand debt funds better, we've got to first understand the concept of debt, Amol. Just to point out to all of the listeners here, if you're familiar with the various forms of debt, do bear with me. It will take only a minute to bring everyone up to speed. So Amol, when we talk about debt, we're talking about money that is borrowed by either the government or a company.
Correct. That's correct.
So it's effectively a loan, and we all know how loans work, right? There is an amount that is borrowed, that is the principal. There is the interest rate, which is the charge, which is what the borrower pays.
Correct.
And there is a particular amount of time within which the amount has to be repaid. In the context of a bond, which is either a corporate bond or a government bond, it is the tenor of the bond.
Correct.
So those are the basics. Yes. And now mutual funds that invest into these papers float what is known as mutual fund debt schemes.
Correct. So as you rightly pointed out, debt fund typically invests into bonds issued by government or government entities, or even a private corporate entities. These bonds are likely to make payments on a pre-decided frequency.
Correct.
It could be monthly, or it could be quarterly, or any such. There are different types of other debt securities like zero coupon bond. But again, for the scope of discussion, we can say that bonds issued by government or government related entities and private sector corporate entities, a fixed income fund that invests into a basket or a mix of these securities is called as, simply put, a fixed income mutual fund or a debt mutual fund.
Now, these are different, and why I wanted to get into the concept of debt is it'll help our listeners better understand why there is a fluctuation in the NAV sometimes. Assuming that no new purchases are made, right? Is because when the interest rate fluctuates, the yield fluctuates, and when the yield fluctuates, the price fluctuates. So there is in very simple terms, an inverse relationship between the price of a bond and the yield on the bond, because it is actively traded.
That's correct, Alex. So in real terms, for an investor, the takeaway over here is, in a falling interest rate scenario or in a falling interest rate environment, your debt funds will show higher gains. Now, this is counterintuitive, but you have nicely summed it up in earlier sentence by saying that yields and prices have inverse relationship. So when the interest rates are going down, your mutual fund will do better. And the other side of it is when the interest rate rises, the mutual fund will have lesser gains or less, the capital gains will reduce from the corpus of the fund, which will reflect in the NAV.
I think a very simple way to explain this, Amol, would be a situation where if I am a holder of a bond which is yielding 8%,
right,
and if interest rates suddenly fall to 7%,
correct,
it would therefore be more valuable when the bonds are being issued at 7%. So you, if you're interested in buying that bond for me, will pay more for it.
Correct.
Okay. All right. So we've talked about the concept of debt, and I'm sure that it's something that's going to be very useful for our listeners. But let's talk about the different mutual fund schemes out there in the debt category. I believe there are 16. And, before anybody gets a little frightened by that number, I think it's very easy to understand now that you know the concept of bonds.
Right.
It's basically categorized by the type of bond or the type of debt instrument. Issuer, yes. And it's also categorized based on the tenor, which we spoke about as the amount of time within which the borrower has to repay.
Yes, Alex, that's correct. So as I earlier mentioned, a fixed income mutual fund is a typically fund that invests into a bunch of or a basket of these securities. However, you can call you can also say that some of the mutual funds do invest exclusively into a particular issuer issued securities or a particular securities that belong to a certain tenure only. So let's talk about two quick examples. There is something called as a gilt fund or a government securities fund. Now, as the name suggests, gilt fund invests only into debt securities that are issued by Government of India. That's it. Very simple to understand. So here we have covered the issuer. Second example in the same issuer category will be there is something called as a corporate bond fund, which invests into AAA rated securities issued by corporates only.
That is the highest rating possible.
Highest rating. So we have now covered via two examples, issuer based segregated schemes.
Yes.
The other type, as you mentioned, it's something which a scheme that invests in a particular length of securities or a particular duration of securities only.
And you mentioned that right at the start. You talked about liquid funds. You talked about ultra short.
That's correct. These are on the lower end. These funds typically have a maturity of up to 90 days or up to 180 days only. I want to give the example. As you rightly mentioned, since we have covered something on the lower side, there is another category in debt funds which is called as a 10-year constant maturity fund.
Yes.
So at any point in time, if you invest in a fund like this, the fund will always hold 10-year long dated securities.
So basically bonds that have 10 years left on their maturity.
Correct.
All right. So we've talked about the broad categories, but there's one more category that I think I've heard about a lot, Amol, in the recent past, especially because yields in the corporate bond space have been going up.
Right.
And that is the credit risk fund, as defined by the Securities and Exchange Board of India. It talks about a large amount or 65% of the assets in such a fund being invested in securities that are less than top rated.
That's correct.
By that very definition, it would mean it's higher risk.
Correct. So as you rightly pointed out, credit risk fund invests major portion of the fund into companies that have lower than the highest credit rating. So by definition, it is lesser, it is riskier. But as we also know in investing world, to a large extent, that risk and returns or risk and reward go hand in hand. Since these are lower rated securities, if you invest, or rather if your fund manager does a proper due diligence on the balance sheet strength of a particular company, even if it is not belonging to the highest rated security, you are likely to get higher returns. But I would again repeat, we don't want any sort of missing communication element over here. With higher prospective returns, there is certainly a higher risk that investor will take even in a debt segment.
The reason, Amol, I mentioned this in particular is because I've also heard this argument in certain circles and we're talking about ILMFS Group, you're talking about SL Group companies that have defaulted, and you have this side pocketing that some mutual funds have had to do.
Debt funds are facing turbulence since last 1 year due to the typical names that you mentioned just now. Yes.
So in such a situation where anyway you're taking the equity risk on board when you're investing in certain funds that have exposures like this, shouldn't you just go for an equity fund?
So, Alex, this is again 100% correct what you said. I just want to give a perspective over here. So, let me repeat what you said. If there is a risk of capital or risk of not getting adequate returns, then what's the point of investing into credit risks? You can simply go to a liquid ultra short or a low duration or even banking and PSU debt fund. Or the other side is, if you want to take the risk, why not go to equity fund? So this is absolutely correct, and one should do it. But I want to give a perspective over here. We spoke about default from 2 or 3 or 4 companies. That's all that has happened over last 1 year. But the size of mutual fund industry in India, as we know, is plus or minus 25 lakh crore. Out of which equity we can say is 40% volume, which is 10 lakh crore. So debt mutual fund forms a part, which significant part, let me add, is about 15 lakh crore. The default, all the defaults that we spoke about do not extend even to a 1% of this entire size.
So it's a very small part.
So a credit risk should not be your chief or largest allocation into your debt funds. Credit risk should be your peripheral or your satellite allocation. So let's say you are running a 60-40 portfolio, for example, 60% debt and 40% equity. Out of the 60 rupees that you are going to put into debt, credit risk can form a smaller part. Let's say 6 or 10 or 15 rupees,
Understood.
not the entire bunch 60 rupees. If you do that, I think that should be, for a lay investor, this is the right way to design a debt portfolio.
I think that's a perfect example of how to do it. But now that we're talking about allocations, and it brings me to the next point, and probably the final point really that we have to have on this conversation. We've spoken about the advantages.
Right.
We've spoken about the types of debt mutual funds. How do you use debt mutual funds? What use do you put it in your portfolio? And you spoke about a 60-40 as an example.
Right.
I would think, and this is something that is spoken about a lot by financial planners, if you have a relatively short-term goal, say something that is below 5 years, you should probably consider doing a debt mutual fund. If you have something that is longer and you have the appetite to take that risk, you should ideally take equity because it gives you higher returns.
Correct.
Is that a fair enough thumb rule to follow?
Yes, Alex, that's something that you can really follow. And in fact, all of mutual fund investors should follow something like this. So you mentioned what debt mutual funds should be used for. So let's start from the very beginning. Let's cover 2-3 fund categories. Liquid fund, as the name suggests, is very, very liquid. So if you want to invest for a duration which is uncertain, so instead of going and locking yourself into a 6-month or a 1 year, let's say a fixed deposit product, where if you redeem within 3 months, there will be an exit load and slightly lesser returns as well. So as a replacement of that, you can simply go and choose liquid funds. That's number 1. Number 2, you want to take, let's say you do not want, other side, if you do not want to take even a little bit of risk on the credit side, there is a category of fund called as a banking and PSU debt fund. Now, as the name suggests, this debt fund invests into debt securities issued by banks, hence the first bit of the name banking, and second bit of the name is PSUs. Right. So it invests into public sector undertakings,
which is
bonds issued by, which is a quasi-government, you can call it. Now, banks and government, both of these, in Indian, a typical lay Indian investor thinks that these are very safe, and they are actually safe if you go by the precedent, if you go by the history. So you can choose a banking and PSU debt fund, which will largely mimic returns from your fixed deposits. But if you stay for 3 years, you get the indexation benefit, what we have discussed in detail few minutes back. So these are certain uses that you can certain specific cases where debt mutual fund will be very, very handy to you.
And broadly, and the second thumb rule to follow, I would think, is if you determine what your overall debt allocation should be, if you have, say, X amount of money, that is your total corpus,
correct,
you shouldn't be leaning too heavily towards either equity or debt. So once you've established what that should be, you can make the allocations appropriate.
Correct. Here I want to make a theoretical point. So even basic reading of personal finance will always tell you that asset allocation is main driver of your portfolio returns than security selection. Let me repeat it for effect. Securities that you invest into play a lesser role than asset allocation at your end portfolio returns. Okay. So what asset allocation is all about? Asset allocation simply means investing into more than one assets. And how it is decided? You should ideally identify your risk appetite. what are the goals that you have. You need not have only one goal which is 3 months away. You need not have only one goal that is 30 years away. You can have multiple goals with multiple timelines. Based on risk appetite and based on your number of years and number of goals, you should decide your asset allocation. If you think you are not competent or if the concept is not clear, you should get a good advisor.
On that note, I'd like to thank you so much, Amol, for joining me on this conversation. I think we've broadly covered all the concepts that have to do with debt mutual
Yes, even
funds.
I think so. Thanks for having me here, Alex.
All right. And to you, dear listener, I do hope that this conversation has been useful to you. If you've got any thoughts that you'd like to share with us, you can write to us on any one of our social media platforms. Don't forget to share this with your friend, perhaps someone who might be interested. Thanks so much for listening. This is Bloomberg Quint.
If you enjoyed Big Decisions, check out some other podcasts on the IVM Podcast Network. You can check out Paisa Vaisa, hosted by Anupam Gupta, Advertising is Dead, hosted by Varun Dugirala, the Ronnie Screwwala podcast, hosted by Ronnie Screwwala, or Cyrus Says, hosted by Cyrus Procha. These shows are available on the IVM Podcast website, app, or wherever you get your podcasts from.
What do we have to do? Welcome to Water Play, you guys. This is the favorite sports podcast of several sports persons such as myself, Dudeja and Mikhail, who also happen to be the hosts.
Yes, you should definitely listen to our podcast for our take and quite a uninformed but hilarious take on sports every week. We give out awards, we discuss what happened in the world of sports, and
we take breaks as well.
We come up with jingles and sound effects on the go. So you should definitely give us an example of a sound effect, Dudeja.
Bolo Matthew Vade.
Yeah, tune in for some of that, bro. You can catch us on the IVM network every Wednesday on the go. On the Wednesday, in the Wednesday. Yeah, Wednesday, Water Player. Water Player W, Wednesday W.
Wow. Oh, Wednesday.
Wednesday to Wednesday, Vade player, Matthew Vade.
Janice, what do you think couples did before TV was invented?
I don't know, go for walks on the beach, long drives, fancy dinners, have more sex maybe?
But what did we do when we decided to move in together? We debated between the Chromecast and the Fire Stick.
We gave up on sleeping early so we could stay up watching true crime shows.
We got ourselves 3 cat babies.
And basically became the cutest couch potatoes around.
Okay then.
In case you guys still haven't got it, we are a TV crazy, Netflix loving, binge watching Mr. and Mrs.
I'm Anirudh Guha.
I'm Janice Sequeira.
And if like us, you snort TV for breakfast, lunch and dinner, this is the podcast for you.
Tune in every Thursday on the IVM Podcast app or wherever it is that you get your podcast from. This is
Mr.
and Mrs.
Binge Watch.